Manpreet Gill, Head of FICC Strategy with Standard Chartered Singapore, joins us live. Manpreet, good morning. Thank you for joining us. There are two talking points, I guess, for everyone this morning. What is going on in China and Ukraine, which is clearly on the front page?
Absolutely, and I think Ukraine is definitely dominating the news headlines, but from a financial market perspective, I would argue that what's happening in China is actually much more important. I mean, Ukraine by itself is a fairly small or negligible part of the global equity market and not a very large component of the global bond market either. The knock-on effect to Russia is important. But you could argue, again, a lot of that is now in the price. In China's case, however, it's clearly a much, much more important part of the global economy, not just because of its share in global equity markets, but ultimately it's one of the world's largest economies, it's one of the world's largest trading economies. So any downside surprise there can potentially have much larger knock-on effects. So when you think about the weight between the two, both are important, but we would argue China is much more important from a risk perspective.
Manpreet, hi, morning. And how damaging could the China impact be for emerging markets like India?
Look, I mean, in a worst case scenario, it obviously can look ugly, but I think our base case is that Chinese policymakers are likely to manage through this. If you think about it, they're really facing a tussle between trying to pull back on credit growth on one hand, excessive credit growth, but without sort of hurting headline GDP growth and job creation too much, below its 7 to 7.5% stated growth target. So that's really the tussle, and you see that constant tussle back and forth in many of the asset classes. You've seen that in the currency market most of all today. So short of a policy mistake, we believe that Chinese policymakers will be able to pull this through, but there will be volatility. This is ultimately a balancing act, and you're going to see, both sides of the equation pulling on the policy levers at different points in time, depending on how far we swing in either direction.
Well, Manpreet, the big one is later tonight when Janet Yellen will present her first speech as the new FOMC chairman. Now, there is a unanimous consensus that she will stick to the original playbook, which is she will continue to taper.
Absolutely, and in our view, that's because the threshold to sort of alter that path of tapering is quite high. I mean, if you have to actually pause tapering halfway through or increase the pace, there will be a lot of explaining needed to financial markets. So it's unlikely they would really play with that. In our view, they'd like to focus more on forward guidance. We believe ultimately what they're looking at through the lens of tapering, the unemployment threshold, their policy goal ultimately is to avoid a massive spike in interest rates and, a continuation of the economic recovery. So we'd like to see more efforts on the forward guidance part. Arguably, some of that is priced in because, that is also fairly well known today. But we'd like to see more sort of focus shifting to that side of the equation. If we look at recent economic data, we do not believe that it was weak enough to justify any altering in the path of tapering. So we're not really looking for any changes on that side.
You think she would blame everything on the weather?
Well, to a large extent, that would be fair. I mean, I think there are two factors at play here. One is the weather itself. I mean, we know historically that does tend to play quite a bit of havoc with, monthly economic data. So, and there is a lot of evidence to suggest that you think about, activity, whether it's hours worked, whether it's, the net number of jobs added, you can see a lot of the effect did come from your classic weather-related signs. Not all of it, but a large part. The second is sort of really trying to see through that and say, okay, what are the trends trying to tell us, the 3-month moving averages? I mean, individual data points have been volatile in the past, so they by themselves are not a great indicator. And you can see that while some of the trends have dipped slightly, they haven't really dipped outside of their usual level of volatility. So if you think about it from a trend perspective, there really isn't enough to say that we've seen a substantial weakening of the economy. We're still largely on the same path. The unemployment rate still continues to come down. So again, it's important to see if this data does improve, but right now we believe there's sufficient evidence to believe the recent weakness was temporary.
How do you expect the dollar to pan out? Because the dollar index of late has been showing you some signs of weakness.
Sure, that's really interesting, but I think the one perspective I want to add on that is, let's not forget that about 60% of the dollar index is comprised just of the euro-dollar pair. So when we think about weakness in the dollar index, a lot of that is coming from the strength in the euro rather than, broad-based dollar weakness. Now, we believe that the path of Fed policy continues to make a case for, long-term dollar strength. But we've also maintained that we expect to see more of that come through on the emerging market currency side, much less so in European currencies. And in our view, that's exactly what we're seeing. If anything, the strength in Europe is arguably a little more than we were expecting, definitely. But in our view, if you expect a continued U.S. recovery, if you expect yields there eventually to rise, and if you expect basic external, fiscal current account balances to continue to improve, in our view, that's ultimately a dollar-supportive environment. Now, from there on, it's just a question of whether you expect to see more of that against some regions or not. We think much less in Europe. We're seeing many of the same catalysts in improving economy, and much more so against emerging markets where, in some parts, risks are still very much in place.